Hey, this is CC back September 12th, about midday through the trading day. Wanted to take a look at the Qs today. They're down on the day, down less than 1%, but um, Oracle reported last night and it's down big, a much larger move than what options were pricing. It's an interesting chart though, because following this slow grind higher, basically since the spring, with very little volatility. This was just a grind higher. The last month and a half or so, we've seen some two-way volatility, some two-way moves, and zooming in on very recently, just the last month. As you see, it was trying to make new highs on the year, failed a little bit, tried to recover, and then today is back down a little bit. What I wanted to look at is out a little bit and look at how options are pricing. In one of the previous videos on the channel, we talked about how Apple, one of the biggest mega cap components of the Qs, had been moving a lot more than what options had been pricing. That's not necessarily the case here in Qs, but what is different is there's likely a bit of a implied vol hangover because of this slow grind. Like even with this little bit of volatility lately, you go to the SPY and the VIX and SPX, the VIX is still quite low, right? Historically, it's below historic averages. So we're looking at Qs, we're kind of looking at these levels and saying, using this expected move chart, when our options pricing moves back to the highs, a potential breakout from this failed high here, or at least a retest of this very recent low about less than a month ago. And what that does is that high probably, let's look at this high right here. It's about 386, let's call it. That's about out to mid-October, right? On the bullish expected move. This low right here, August 18th, is 358, let's call it. Looking out on the expected move, that's about to the end of October, right? So I wanted to look at some potential bearish positioning. This chart does not look great unless the Qs were to reverse and the market were to reverse and it were to go higher, which means that this prior low in August, recent prior low, is very much in play, right? And what's interesting about the level of implied vol, which is, you're coming out here to the end of October, it's only about 18. It's below historic levels. In fact, if you come down here on the option data, the 360-day IV is 22, so it's below that level. The realized 250-day vol, that's how much the Qs have actually been moving, is also higher, 24. Now remember, that includes this very low volatility climb higher, going back to basically the beginning of the year, but really the spring. This is where you saw the VIX at with a 12 handle, right? So anyway, it's interesting to look at these levels and be like, that's a very realistic level for the Qs to visit. And the way options are pricing it, that's the sort of move, given that what's happened in this past month with these moves higher and lower, that could happen, very much before the end of October. I mean, this is a 45-day time frame we're looking at right here with the expected move. So let's look at some put spreads down to that level. Here it is on a 1-month chart. Let's look at it 3 months right here. And let's go bearish. And let's look at some put spreads. Actually, a put spread. So let's go change this to end of October. Just hit recalculate real quick and it'll hit the expected move strikes. So that's, roughly in line with this level. Maybe let's tick it down maybe a couple strikes. Let's catch this low. All right, right there, 355. 375. And let's just take this upper level, put it, just $1, not even $1 in the money. And, then we have a easy math 20 wide put spread, right? So let's check out the metrics here. It's about risking about 550 to make 1450, 40% probability of profit. Our break even is 369.51, right? So, the Qs are down $3 today, right? Which isn't even that massive of a move. It's not even down 1% on the day. So that's $3 today. And, we're looking at a $5 move lower, but we're giving ourselves 45 days for this to happen, right? And this is the way I like to look at the risk reward of these trades. You can see on the details if you want to come in here and see the what you're doing. So, if you were just to buy this 375 put outright, you'd be paying almost $9. By selling that 355 put at this this level we're targeting, taking more than $3 off of this trade, risking about 5.5, right? And that's sort of the beauty of trading to the expected move, and that's the beauty of using a debit put spread. In this case, is we're getting a very realistic break even. I mean, incredibly realistic break even. And this isn't to say that the Qs are going to continue lower. We don't know, but based upon the chart and this potential for it to roll over, this is a very realistic trade with a very tight break even. This is not playing for a massive home run for the Qs to just puke into year end or even for the next month and a half. This is to say, all right, what if this sell-off today followed through for a couple more percent? Very realistic trade, right? And very good risk reward in this case. So, this is the way that I tend to look at trades like this. If I'm chart trading in particular, I'm looking for what's a good risk reward if something very realistic happened. And in this case, if you were bearish near term over the next month and a half in Qs and the market in general, this is the type of trade that I would be looking for.